Okay, let's unpack this. Today, we're diving deep into the latest market movers, starting with that surprising inflation uptick. It seems to be keeping the Fed firmly on the sidelines,
Right.
and also looking at how these escalating tariff threats are actually playing out, for corporate earnings and global trade.
And it's pretty fascinating, isn't it? We're seeing this disconnect between what the White House says about tariffs and how Wall Street is, well, reacting. Or maybe not reacting.
Exactly. Not as clear-cut as you might think.
Hmm.
So our mission today is to cut through that noise, give you the unvarnished facts, and really help you understand what all this means for your portfolio, especially with futures this morning looking a bit, well, sluggish.
Yeah, definitely sluggish. We've got the Dow essentially flat, S&P 500 futures down just a hair, minus 0.07%, and the NASDAQ 100 futures slipping about minus 0.19%.
Definitely a subdued start.
Yeah, not exactly jumping out of bed this morning, especially after yesterday's CPI report.
So these early morning jitters, are they just typical pre-market noise? Or, are we seeing a market that's maybe still clinging to rate cut hopes, making it really vulnerable to any hint that inflation is sticking around?
That's the key question, I think. It could be signaling something bigger, a shift from maybe buy the dip to more like brace for impact.
Right.
So for your actionable strategy here, you want to watch the Dow. Look for further downside, particularly if the S&P and NASDAQ futures deepen those losses when the market actually opens.
Okay, let's talk inflation then, because the June Consumer Price Index just dropped, and yeah, it's showing some heat.
Yep.
We saw a 2.7% year-over-year increase.
Up from May's 2.4%.
Exactly.
And here's where it gets really interesting. You can see the tariffs starting to leave their fingerprints.
Yeah, how so?
Well, prices for imported goods are showing, scattered signs of impact. Look at household furnishings. Specifically, furniture saw a 1% jump just in the month. That's the biggest gain since, January 2022? Back when inflation was really surging?
Wow. And that's not a coincidence, is it? Categories like furniture, appliances, they rely heavily on imported parts or even finished goods.
Absolutely. Tariffs get slapped on, those costs get passed right through to you.
And it's not just the big stuff. Recreation, apparel, even appliances all ticked higher in June. And, your grocery bill, too. Overall grocery prices up 0.3% in June.
And get this, they're a steep 27.4% higher than just a year ago.
Ouch.
Yeah. Case in point, ground beef is nearly 10% higher than last year, averaging like $6.10 a pound.
Ah, grief.
And while eggs dipped a bit from May, still way above last year's price, this isn't just theory, right? It's hitting your wallet at the checkout.
Absolutely. So the big question for investors has to be, how much of this inflation is really transitory versus maybe a longer-term trend that's now kind of baked in because of these trade policies?
That's the million-dollar question. Some argue it's temporary shocks, but you see this sustained uptick, especially in those tariff-exposed goods. It suggests something maybe more structural.
Yeah, feels like real costs being passed through.
Definitely. So for your actionable move here, maybe you review your spending, especially in those tariff-exposed areas like home goods, clothing. Might even think about buying some staples in bulk. Try to lock in current prices.
Good advice. Okay, so that's the pain at the checkout. But how are these rising prices hitting decisions in the Fed's boardroom?
Well, this latest inflation data, it's firmly planting the Fed on the sidelines. CME Fed Watch now shows a 97% chance of no rate cut in July. 97%.
Almost certain, then.
Almost certain. And it doesn't stop there. Hopes for September, they're fading fast too. Odds slipped to just 44% after this report came out.
Wow.
You hear economists like Scott Anderson at BM Capital Markets saying, look, this heating up of inflation is a step in the wrong direction. It's going to keep the Fed on the sidelines. That's the consensus view now.
Interesting. And look at the bond market's reaction to all this.
Yeah.
We're seeing the 10-year Treasury yield creeping up near 4.5% and the 30-year yield pushing past 5% for the first time since early June.
That's the bond market speaking volumes, right?
Yeah.
Direct response to those rate cut bets evaporating.
Right.
It's like a vote of no confidence in that transitory inflation story.
For sure. And this is all happening even with President Trump furiously calling for rate cuts.
Oh, yeah. He even called Powell's handling of that Fed headquarters renovation, the $2.5 billion one, a fireable offense.
Strong words.
Clearly thinks the Fed's getting it all wrong. So with Trump pushing Powell that hard, How do you see the Fed actually maintaining its independence through all this?
That is the constant tightrope walk for Powell, isn't it? Historically, the Fed guards its independence fiercely. It's built into their mandate.
Mm-hmm.
So while the rhetoric is loud, I think ultimately the data drives their decisions.
Hopefully.
Yeah. So for us, that means keeping a close eye on Treasury yields, maybe consider strategies that could benefit if rates stay higher for longer, things like short duration bond ETFs.
Good point. Okay, let's shift gears. Let's talk about the dollar. Because while tariffs might be hurting consumers, that battered greenback is actually a bit of a boon for some U.S. companies. The dollar index, the DXY, it tracks the dollar against 6 other major currencies. It's down about 10% year to date.
10%, that's significant.
Huge drop. And almost half of that has happened just since April 2nd, right after Trump announced those big import tariffs.
Interesting timing.
Very. And a weaker dollar means, it's cheaper for U.S. multinationals to bring their foreign profits back home. Plus, it makes U.S. goods more competitive overseas.
Right. I saw some analysis from Macro Hive suggesting every 10% drop in the dollar could translate to roughly a 2% profit surprise for the S&P 500 overall.
Wow, 2% boost.
Yeah. So tariffs might be a headwind, but this weak dollar could be a pretty strong tailwind, especially now with Q2 earnings season really getting going.
But there's always a flip side, right?
Always.
What's good for U.S. multinationals, not so great for European exporters. The euro has shot up over 12% against the dollar just since the start of the year.
12% gain for the euro.
Yeah, and some projections are even looking towards a 20% gain. You've got Italy's business lobby head calling this dollar devaluation the highest tariff Europe is already facing.
Saying it threatens, what, 37.5 billion euros in Italian exports if Trump's 30% tariffs actually hit?
Exactly. Big numbers. So, knowing earnings season is here, how should we be thinking about adjusting portfolios for these currency swings?
Well, the key is really understanding who wins and who loses from this.
Right.
So for your actionable insight, look for those large U.S. multinationals, the ones with significant foreign revenue. Their Q2 earnings could get a nice little boost, maybe an unexpected one from these favorable currency conversions.
Gotcha. Focus on the foreign exposure.
Okay, speaking of tariffs, we are heading into what looks like a pretty high-stakes showdown on August 1st. That's the date President Trump has threatened to impose those 30% tariffs on the EU, Canada, and Mexico.
Yeah, August 1st deadline looming. And Europe is definitely not just sitting back. France seems to be leading the charge to activate the EU's most powerful trade tool.
The anti-coercion instrument, the ACI.
That's the one.
Yeah.
Sounds serious. And it could give them broad powers to retaliate. Think new taxes on U.S. tech giants, maybe curbs on investments, even restricting U.S. firms from public contracts over there.
It really does feel like a global trade war chessboard right now.
Totally. A French official even said, in this negotiation, you need to show strength, force, unity, and resolve. They're not ruling out going even further than the 100 billion euros in countermeasures already talked about.
They mean business.
Seems like it. But what's really curious here is how the markets are reacting, or, again, maybe not reacting to all this saber rattling.
Right. Yahoo Finance had a piece on this. The White House says, see, market resilience means they accept tariffs. But a lot of market watchers are saying, hold on, they think traders are just ho-hum because they simply don't believe Trump's latest threats will actually happen.
So, 2 totally different explanations for the same market behavior. They can't both be right.
Exactly. And some are worried the markets might not be fully grasping the potential bumpiness likely ahead, as they put it.
That's a critical divide. If Wall Street is betting these are empty threats, and they turn out not to be.
Big disconnect. Massive potential for volatility. So for your actionable strategy here, given these mixed signals, maybe consider option strategies, ones that factor in potentially higher volatility around these geopolitical dates.
Makes sense.
And definitely review your positions in companies that rely heavily on that transatlantic trade corridor.
Good call. But, it's not all headwinds and trade wars. Interestingly, some sectors seem to be finding unexpected tailwinds in all this turbulence.
Oh, yeah. Like who?
Well, look at Bank of America. Just reported profit that beat estimates. And guess what drove a big chunk of it?
Let me guess. Trading desks.
Bingo. BofA sales and trading revenue jumped a whopping 15% to $5.4 billion in the quarter.
15% jump.
Yeah, marks their 13th straight quarter of year-over-year revenue growth in trading. Equities revenue surged 10%. And FICC, that's fixed income, currencies, commodities, jumped 16%.
And it wasn't just BofA, right? I saw JP Morgan Chase and Citigroup also beat their Q2 profit estimates.
also largely helped by trading gains.
Seems like turmoil equals revenue for the big banks.
Pretty much. Their trading desks directly benefited from all the market turbulence in Q2. Clients reacting to shifting U.S. trade policies, geopolitical tensions, it all drives activity.
Clear sign that volatility creates opportunity, at least for them.
For them, absolutely. So does this mean volatility is actually a friend to the financial sector right now? Should we, as investors, be looking at bank stocks differently because of this?
It's a fair question. For these big institutions, volatility means more client activity, more transactions, maybe wider spreads on certain trades. It does suggest a certain resilience for the sector in these conditions.
Hmm.
So, for your actionable takeaway, definitely watch the upcoming earnings reports from the other major banks, especially ones with strong trading operations. They could be a good barometer for whether this market volatility keeps translating into revenue.
Okay, good one to watch. So, as we start to wrap up this deep dive, what else is still firmly on the radar?
Well, today we get another inflation pulse check. The Producer Price Index, or PPI, is out. That measures wholesale inflation, basically what businesses pay for inputs.
Right, PPI.
Mm-hmm.
And it's expected to show a bit of a pickup, too, similar to what we saw with CPI yesterday.
That's the expectation. And on the earnings front, we already got a pretty big warning shot fired this morning.
Oh, yeah? From who?
Chip gear maker ASML, their shares slumped almost 8% in pre-market trading after they warned on their 2026 growth outlook.
Oof, 8% drop pre-market. What reason did they give?
Their CEO specifically cited, quote, macroeconomic and geopolitical consideration and tariffs
Yeah.
as reasons for increasing uncertainty.
Tariffs again, directly impacting outlooks.
Exactly. And that's significant because ASML is such a linchpin in the whole semiconductor industry. Their outlook can definitely ripple across the tech sector.
For sure. So beyond the banks and ASML, earnings season is really kicking into high gear now.
Yeah. We're heading into that period where the mega cap reports start rolling in. They'll give us crucial insights into how companies are navigating these tariffs, the sticky inflation, that strong dollar we talked about.
Right. Remember, the market's always looking forward. These earnings calls, the guidance executives give, that tells us a lot about how they see the trade landscape evolving and what they're actually doing to manage these impacts.
So how should you be adjusting your earnings season strategy, given these clear impacts from tariffs and currency swings we've been discussing?
I think the crucial adjustment is really digging deeper than just the headline numbers. Pay super close attention to the corporate guidance, especially around supply chains and their international revenue exposure on these upcoming earnings calls.
That's where the real story is going to be.
Exactly.
Okay, so let's pull it all together. What's the big picture takeaway from today's deep dive? We've got this market kind of digesting conflicting stories on tariffs, a Fed that seems stuck on the sidelines,
Definitely stuck.
and companies navigating a genuinely volatile economic landscape. One interesting trend, though, amidst all this uncertainty, is gold.
Ah, yes, gold. Acting like that classic haven asset. It's risen over 25% this year, right? Trading near $33.40 an ounce.
Yeah, over 25% gain, supported by all those anxieties over trade tensions, geopolitical stuff, exactly what you'd expect.
Exactly. And on a completely different note, but still impacting investors, President Trump is apparently set to sign an executive order allowing retirement plans, like 401k, to invest more heavily in private assets.
Opening the door to potentially riskier but maybe higher return investments in retirement accounts? Interesting development.
Yeah, one to watch. So clearly the market right now demands agility. You really need a deep understanding of all these intertwined forces.
Absolutely. Whether it's the real cost of tariffs hitting your household budget or the strategic chess moves of central banks and global trade partners, staying informed is just critical.
So here's a final thought for you to chew on. If the White House and Wall Street can't even agree on why the markets seem ho-hum about these tariff threats, who do you think is correctly grasping the bumpiness likely ahead?
Good question to ponder.
And for your actionable strategies heading into the rest of the week, maybe consider some defensive staples for portfolio stability. Could explore dollar-hedged ETFs if you think the greenback slide continues. And maybe even research some potential calendar spreads on Treasury ETFs to play those shifting rate expectations.
Lots to think about. That's our deep dive for today. We really hope this gave you the edge you need to navigate these turbulent waters.
Yeah, hope it helped. For more insights and actionable strategies, smash that subscribe button and definitely catch our live Thursday night Market Lab. You won't want to miss it.